Welcome back to Alpha Recap, your quick wrap of the market day. We're coming to you after the close with a big risk-off move to unpack. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Tough session today. A sharp sell-off led by tech that rippled across the board. Lots to dig into.
So, what really stands out here is how quickly the market flipped. It went from steady to risk-off in a single day.
Right, and that flip showed up in the headline numbers. The S&P 500 exchange-traded fund finished the day down about 2.5%. The tech-heavy NASDAQ 100 fund plunged about 4.8%, and small caps dropped about 3.5%.
Big move. When those three things line up, big tech, broad market, and small caps, it tells you this was more than just a single stock scare.
I mean, when you step back and look at this, three forces really converged. Rising banking risk signals, another leg lower in crypto that triggered margining and wash-throughs, and concentrated profit-taking in long-duration growth names.
Yeah, that tracks. Let's break those down. First up, the banking and finance story. Coverage flagged higher risk indicators in the bank sector today, and that tends to put pressure on cyclical and small cap names because credit and liquidity concerns matter more for them.
Exactly. Rising risk premia mean traders are less willing to hold positions that lean on easy credit. So small companies and regional bank-exposed names got hit harder, and that showed up in the small cap funds drop.
Not a great day for regional banks. Honestly, I was a bit surprised by this one.
Me too, especially because there wasn't a single big new regulatory announcement. It was more the market repricing probabilities and marking up perceived credit risk.
Right. And the other thing is crypto. Crypto slipped again, and that created ripple effects. Funds with crypto exposure had to de-risk, and that pressure spilled into fintech and payments names.
Yep, cross-asset contagion is real. Crypto declines can force margin calls for leveraged players, and they sell anything liquid. That feeds into equities, especially corners that intersect with digital assets.
And then you add tech concentration. When a few mega-cap names have driven gains, profit-taking there amplifies headline moves. The NASDAQ 100's almost 5% fall shows how concentrated the pain was.
Which brings us to sector behavior. Tech and communication services led the losses. Software, AI-related names, and richly valued semiconductors took the brunt. Meanwhile, utilities and consumer staples held up relatively better as investors rotated into quality and defensive income.
So this wasn't a constructive rotation into cyclicals. It was more a flight to safety, trimming risk and chasing stability.
Exactly. Industrials, materials, financials underperformed too, which matches the banking risk story. Energy was mixed. Geopolitics and renewables were in headlines, but the sector didn't move as much as the broader sell-off.
Short reaction.
Big move in tech.
Cyclicals lagged.
Defensives held up.
Let's talk about some of the name-level calls people noticed. Truliev's listing got attention as a notable corporate action in the cannabis industry, but it barely mattered in the face of the broader sell-off.
Meta was also part of the conversation. The multi-year narrative about concentration shows up again. Movements in a handful of big-cap names really sway indexes when they're that concentrated.
Trane Technologies and other industrials came under pressure too, as investors reacted to earnings and outlooks. Cyclical exposure equals vulnerability in a risk-off day.
And even defensive growth themes, like cybersecurity vendors, weren't entirely immune. Mythos popped up in coverage around earnings and interest, but the broader de-risking led traders to reduce leverage across many themes.
Quick aside, short reaction.
Earnings mattered less than headlines today.
Totally. Moving to macro implications. No Fed decision was made today, but the market behaved like the distribution of future Fed outcomes widened. That's key for long-duration growth.
Right. Analysts note that if traders start pushing out expectations for cuts, or if term premia rise, richly valued growth names get repriced. So even without a fresh Fed move, policy uncertainty was the silent background driver.
Inflation and labor remain central. Any surprising upside in inflation or employment data would make policy less predictable, and that increases volatility. Credit and liquidity are also on watch because rising bank risk indicators matter for smaller, leveraged borrowers.
Technically, breadth internals were weak. Decliners overwhelmed advancers. Volatility metrics spiked, so hedging costs went up and VIX-like measures jumped. Traders will be watching moving averages and prior consolidation zones for signs of stabilization.
So, what really stands out here is the speed. Oversold readings could attract short covering and quick bounces. But without supportive macro news, those relief rallies may be choppy.
Exactly. Expect higher volume and wider intraday ranges near term. Headlines will dominate price action, and guidance misses in earnings season could be punished more severely in this environment.
Let's lay out what we'll be watching next, session by session. 1. Any clarifying news on banking and credit risk. 2. Whether crypto stabilizes or falls further. 3. Key economic prints and Fed speeches. 4. Corporate earnings and guidance.
Yep. If regulators or big banks can contain the credit story, that soothes markets. If crypto keeps dragging, we'll see more volatility in fintech and payments names. And the data calendar could tip the scales on rate expectations.
Quick confirmation reaction.
Containment calms things.
Further negative signals deepen the sell-off.
And of course, corporate guidance will be a mood maker. A single cautious outlook in this moodier market can elicit outsized moves.
A couple of historical notes to keep perspective. Tech-led pullbacks of this magnitude have happened before when long-duration cash flows get repriced. What matters is whether selling spreads to credit and creates a deeper cycle, or whether it's contained to price discovery in overbought names.
Analysts note that the presence of banking stress and crypto contagion raises the bar for a quick recovery. So the context today is a little more complicated than a routine tech correction.
All right, time for key takeaways. 1. This was a clear risk-off episode. Broad selling led by tech and small caps. 2. The drivers were a mix of banking risk signals, renewed crypto volatility, and concentrated profit-taking in growth. 3. Defensive sectors outperformed, but breadth and volatility worsened. 4. Near term, watch credit headlines, crypto stability, economic data, and corporate guidance.
And a quick reminder, this analysis is informational. Analysts note trends and data, but this is not personalized investment advice or a recommendation regarding any specific security.
If you want to dive deeper or ask follow-ups, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next close to recap how things evolved and what changed in the headlines.
See you next time on Alpha Recap. Stay curious and keep asking questions at stockalpha.ai.